Have you been told no more lending by your current bank? So, if your current bank has said no more lending, that's probably true. Just like everything in life, there are levels to things. So, in lending, there's also levels. So, think of level 1, level 2, and level 3. So, let me explain. When we start off, we want to use a tier 1 bank, right? These are generally going to be your major banks. We want to use them first because they are harder to borrow from. They're more competitive when it comes to interest rate, but these banks will generally lend you around 6 times your total income. So, once you hit that capacity, generally you can't really borrow more. Then you have to go into a tier 2 lender. So these are non-bank lenders. They're suitable for your growth phase. Interest rates are going to be moderately higher than your previous rates on a tier 1 bank, but they also have more flexible debt to income ratios. They also use a lower assessment when it comes to your buffers, which means it is going to be easier for you to borrow more. Then you get to a tier 3 lender. These are non-bank lenders as well, but they have very high lending limits and they usually charge high interest rates, which means they aren't meant for long-term use. And they generally don't have a debt to income ratio capacity cap, which means you could have more and more debt, but as long as you service the lender's calculator based on the ability to repay the loan, they will lend you. So using this tiered approach can really help you scale your portfolio. So remember, use a tier 1 bank to build your foundation, a tier 2 lender for growth, and a tier 3 lender as an accelerator when the traditional banks say no.